Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, the Monetary Policy Committee, which met on 6th, 7th and 8th of February, that is culminating today. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Monetary Policy Committee, that is MPC, decided by a 5-to-1 majority to keep the policy rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25% and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The momentum in domestic economic activity continues to be strong. Headline inflation, after moderating to 4.9% in October, rose to 5.7% in December 2023. This was primarily due to food inflation, mostly vegetables. The softening in core inflation, that is CPI inflation excluding food and fuel, continued across both goods and services, reflecting the cumulative impact of monetary policy actions as well as the significant softening in commodity prices. The uncertainties in food prices, however, continue to impinge on the trajectory of headline inflation. Taking into account this growth inflation dynamics and the fact that transmission of the cumulative 250 basis points policy rate hike is still underway, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will carefully monitor any signs of generalization of food price pressures which can fritter away the gains in easing of core inflation. Monetary policy must continue to be actively disinflationary to align inflation to the target of 4% on a durable basis. The MPC will remain resolute in this commitment. The MPC also decided to remain focused on withdrawal of accommodation to ensure fuller transmission and anchoring of inflation expectations.